What's going on, my fellow YouTubers? Today I'm going a little different approach, and we're not doing a video on a tech stock or an innovation stock. As requested by one of our subscribers, we're doing a breakdown or a review of a particular company that is a restaurant and also right now trading as a penny stock. So with that being said, if there is a particular company that you would like us to do a review or analysis on, throw that ticker symbol or that company name in the comment section and we'll try our best to get one done for you. The company we're talking about today is called Muscle Maker Gril, and their ticker symbol is GRIL, which is, quite fitting since they're a grill. Now, before we get all nerdy and start looking at the financials of this company, I'm going to briefly go over what they provide to its consumers and really what the basics or the foundation of the company is. Founded back in 1995 in New Jersey, they now offer a wide variety of healthy options to include burgers, salads, wraps, bowls, and my favorite at any restaurant, a good old smoothie. Their main goal is to provide a healthy option or alternative to the traditional fast food industry that we've seen like McDonald's. They have really experienced a decent growth rate the past couple of years as far as their franchises, and now have gone to over 50 locations across the United States and over 1,000 employees. I started looking at this company, and they even have an international location now. They have a franchise or a restaurant based in Kuwait City. So when I first started looking at this company, the thing that really piqued my interest is although they are concentrated more in New York and New Jersey, which makes sense, that's where they were founded, they have really spread across the West Coast, the East Coast, down in Florida, across the Midwest, which is probably a testament that their food or their product is resonating with people of all different types and backgrounds, which is a very positive sign for a company as they start expanding and growing. Back in 2019, they come out and announced that they were going to be expanding and be located on their 6th Army and Air Force base, which allowed them further expansion into a stable market. Then last fall, they announced they were adding 2 more locations to 2 separate naval bases. So being a veteran myself, I know we're very picky on certain things, so I reached out to a couple buddies that were stationed at bases where a couple of these locations were and said, hey, have you tried this food yet? Do you like it? What's your overall take on it? And overall, they really seem to like the food. They like having a healthy option, whether it's a burger or a wrap, compared to the staple restaurants that used to be on military bases and really still are, as far as like Burger Kings. So let's change gears and start looking into what really matters for us as investors, and that's the financials or the outlook for this company. Their stock price right now is trading around $2.38 a share at the time of this video, with posting a 25% loss for the year. So I'm gonna pause real quick and just come out and say it. I don't like the fact that it already has a 25% loss for the year to date on this particular stock, at a time when almost every other restaurant, either similar in size or major in size, has been posting great returns because of the virus, where everyone cannot go to a restaurant and sit down. They are getting things to go. So this is a little alarming to me, or it's throwing up a red flag that they're showing a loss when all the peers in the industry are showing a profit. For comparison, Fat Brands, which owns Johnny Rockets, posted over a 400% return, and Barbecue Holdings posted over a 200% return as well. Even Chipotle Mexican Grill, which I know is a larger company across the United States, posted a 182% return. So I will play devil's advocate on this one. When you look at 2 areas where the majority of the franchises or the restaurants are located, it's in New York and New Jersey. 2 states which probably has some of the strictest and earliest shutdowns and lockdowns pertaining to the virus. So this could play into the reason why they aren't posting as big of returns as the other companies, because the main income or revenue source was in these 2 states. So I'm going to play devil's advocate and go ahead and say this could be a possibility of why they're experiencing a loss compared to the other companies, which have more locations across the United States that didn't experience the shutdowns quite as fast as these 2 states. But when you look at the overall growth number, Muscle Maker seems to be doing very well compared to its competitors and peers, and seems to be growing at a decent pace, which is obviously a good sign for a company. Their earnings before interest and taxes and amortization year over year is up over 200% so far, and their total asset 3-year, the CAGR, or the compound annual growth rate, is up over 26%, which to me is pretty decent numbers. However, there is a catch sometimes that you have to pay attention to, and that's just because you're growing doesn't necessarily mean you're making money. One issue is when you grow or expand as a company, you're going to accrue more debts and take a loss. Think of it, if you're expanding as a restaurant, you buy a piece of land, you build the building, you have to put in the ovens, the grills, you have to train staff, so you're going to take initial loss before you start bringing in that revenue, which is going to take a couple years to even break even because your initial investment. This even applies to companies like Amazon, UPS, the list goes on and on. So it's not necessarily a bad thing, but it does impact the company's particular financials. However, when you start looking at the actual profitability numbers, it doesn't look good when you compare it to their peers or their competitors. So when we start looking at the profitability numbers, it doesn't really look good for Grill compared to its peers and its competitors. As you can see, I've circled it in the red on the left, and everything seems to be in a negative when we're talking about profit. Everything from gross profit margin at the very top, down almost 9%, to earnings before interest and taxes margin, which is almost down shy of 200%. Then return on equity, which is down over 1,000%. So they definitely have some issues as far as turning a profit. Even cash from operations is down negative $6.6 million. So my general synopsis on this is I definitely think this company has a future. I mean, they're growing, they're expanding, they're popping up locations all across the United States. I mean, they're obviously doing something right as far as business management and being able to reach out to new franchise owners and grow. However, for my personal investment strategy, I'm not buying into this company right now, and here's really why. After the virus hit everything in 2020, I'm very leery on businesses that are greatly impacted by public health safety, i.e. restaurants, dining restaurants that are kind of forced to change and adapt. They suffer greatly, and it's going to take some restaurants a while to bounce back to get more into a profit area that investors want to see. If you look at companies that didn't have dining options like Domino's, Papa John's, other companies similar to that, they surged during the pandemic. So there are ways to make money in retail food industry. It's just as a company is growing, I'm just leery. It kind of made me reevaluate my investment strategy on investing into food-based companies. So the thing is, if you watched any of my videos in the past, you know I'm very heavy on long-term investing. And while I do think this company has a future, I just don't see it as a way for me to make a lot of money investing in this company. I think it's going to take a really long time for me to make the returns that I want when there are other companies similar that I can invest my money into as far as a buy-in price and financials and get a better return on my money over the next 3 to 5 to 10 years. So before all the haters start commenting and blowing me away, I'm not saying I don't like this company. I've always said it multiple times in the video. I think they have a future. I'm intrigued by it. I wish they was closer to me so I could really test out the product myself. It just doesn't fit into my personal investment strategy. It may fit into someone else's, and that's fine. I hope this company is very successful. I hope people make a lot of money on this company. I love seeing people risk everything and turn it into a successful, growing business. It just really, that's part of the American dream, or part of the capitalist dream that offers people here in the United States. That's it for me today, guys. Thanks for watching. I hope your stocks turn greener and greener every day. I hope you stay safe, and later.